Hola mi gente, welcome back to the channel. My name is Sean and this is We Are Investing, a channel that's dedicated in investing and personal finance. On today's video, I'm going to show you how to trade credit spreads on Robinhood. We'll go over call credit spreads and put credit spreads on today's video. This video is not intended for somebody who's never traded options before. I highly recommend that you know how to buy and sell calls and puts before you start dabbling into spreads. But this video is intended for somebody who has never done a spread before or is very new to trading credit spreads. Now, I do have a playlist regarding a ton of things on Robinhood, talking about how to buy and sell stock, talking about a ton of options trading strategies. If you want to catch yourself up to speed, then I highly recommend you take a look at that playlist and dabble in some of the videos on some topics that you might not fully understand and that you might not be good at. I'll throw a link to that playlist up at the top of the screen, and I'll also include it down below in the video description. And if you want to stay up to date on future videos, then I highly recommend that you hit that subscribe button and ring that bell so YouTube will notify you when I upload more videos. And do us a favor and smash that like button to help with the YouTube algorithm. I really do appreciate it. And comments are welcomed down below as well. We're a community where we learn together, grow together, and make money together. Now let's get started. Let's hop on over to the mobile device and I'll show you how to trade credit spreads on Robinhood. Now, if you don't have Robinhood and you are going to sign up, I highly recommend that you use the referral link down below in the video description to get yourself free stocks worth up to $200 by using that link down below. When you sign up with Robinhood, you will also need to be approved for level 3 options trading. If you're not approved, you won't be able to buy or sell spreads. So you'll have to get approval. To do so, you're going to click on that little person icon on the bottom right. You go to investing, you look at your options trading status, and you'll apply for level 3 if you're not already approved. Now to get started, we are going to look at how to trade call credit spreads. Now a call credit spread is when you are bearish on a stock. It's opposite of buying a call when you are bullish on a stock. With a call credit spread, you're going to keep all of the money. Your max profit is going to occur if a stock stays below a certain price. So you don't want the stock to move up. There could be some movement to the upside and you'll still make the most amount of money, but you don't want it to go above your strike price. So you are therefore bearish on a stock, thinking that it's either going to stay flat, go down, or it could potentially move up a little bit depending on what strikes you pick. And the reason why it's called a credit spread is because you are going to receive a credit, you are going to get paid up front to enter this position, as opposed to a debit spread where you actually have to pay to enter into a position. With that being said, credit spreads will not be as lucrative from a risk to reward perspective. Because you're getting paid up front, you are not going to make as much money, but the probabilities of you keeping your max profit are much higher than buying calls, buying puts, or entering into debit spreads. Now to get started, we need to find a stock that we're bearish on because a call credit spread is a bearish move. It's a bearish trade. So to do so, let's just pick a stock that I'm not really bullish on and I'm bearish. We'll pick Peloton, PTON. We'll select Peloton. It's currently trading at $23.47, and in the last month, the stock is down 23.43%, and it's definitely in a downtrend. Now, I'm not actually going to enter into this trade, but if I was, this is the process that you would take. You're going to have to do some due diligence, some technical analysis, and identify a resistance, a price that you don't think Peloton is going to break through. That could be right here at this resistance that's around $29. So obviously you're going to do way more technical analysis and due diligence before you enter into a trade. This is not good enough, but let's just roll with it. So let's say we don't think Peloton's going to get above $29 in the next month. So to enter into a call credit spread to play that out, we're going to hit trade. We're going to go to trade options. Now the expiration, let's just pick the end of the month or the beginning of next month, which is April 1st. So we'll select on that date up top. Now, the first step in getting into a call credit spread is you need to sell a call option. So we need to click sell up top and we need to have call option selected. Now, we said that we don't think Peloton's going to get above $29. We also don't think Peloton's going to get it above $30. So that's the first strike that I'm going to select. It's the $30 call. Now you can see that it's currently trading at 68 cents. Which is $68 because you times that number by 100. So that's going to be our first leg of the call credit spread. So we'll select that. Now the next step with a call credit spread, and the reason why it's a spread is because you're buying and selling an option at different strike prices for the same expiration date. This will make more sense now. So as you can see, when we scroll up and we get further out of the money, we move up in the strike prices, the premiums are dropping. We're selling that $30 call and we're going to get paid $68 for doing so. That would just be selling a call option. But we don't want to do that. We don't want to sell naked calls. We're going to do a call credit spread. So what we need to do is we need to select another option as a hedge, one that has a higher strike price. Let's say the $35 call. So this would be a $5 spread. Now notice that the premiums for the $35 call are 25 cents. So $25. So essentially we're getting paid $68, and then out of that $68, we're using a portion of it to buy the $35 call. So we're going to click buy up top, we're going to hit call, and then we're going to select that $35 strike, which is currently trading at 25 cents. So down below, now that I have both of those selected, you can see that it says call credit spread. Now, when you select on that, you can see that our total credit is 43 cents. Well, you times that by 100, it's $43. I would get paid $43 to enter into this trade today. And to calculate that, that's real easy. It's the amount that you got paid for that $30 strike minus the amount that you paid for that $35 strike. Now in Robinhood, if you click that arrow, you will also get your profit and loss graph. Now I mentioned this earlier in the video, it's not going to look very appealing, but it's based off of probability. The probability of Peloton getting the $30 in a month is unlikely. For it to get to $35 and occur that max loss is even less likely. So from the profit and loss graph, it doesn't look very appealing because your max profit is the credit you received up front. In our case, $43. But the max loss is going to be much higher. It's going to be $457 for this trade. To calculate that, you take the spread, $35 minus $30, so a $5 spread, times that by 100, so $500, and then you subtract the credit that you received for entering into this trade, $43, and that's where you get your max loss of $457. Now the max loss will occur at the higher strike price, so if Peloton's at $35 or higher. Your max profit, the credit of $43, will occur if Peloton is below or at $30 by expiration. Now your break even is also very easy to calculate. It's that lower strike plus the credit you received. So the lower strike is $30, the credit we received is 43 cents, so our break even occurs at $30.43. Now that is the math behind a call credit spread. And you don't have to hold these till expiration, you can trade them. But I do recommend that you take a look at the options that you're trading and make sure that they have relatively good volume. If they have volume, then you should have no problem actually closing out of this position because you need somebody to buy the one contract and you need to be able to sell the other contract to somebody as well. So liquidity is important. It's always important with options trading, and that's about as deep as we're going to dive into volume and liquidity in this video. So essentially with this call credit spread, we are bearish on Peloton. We don't think it's going to get above $30 a strike based off of that resistance. We're going to get paid $43 up front, and if our trade works out, we're going to keep all of that premium. The worst thing that can happen to us is if Peloton gets to $35 by the end of the month, and then we would lose $457. Now that we explained a call credit spread, let's explain a put credit spread. Now, opposite of a call credit spread, which is when you are bearish on a stock, a put credit spread is when you are bullish on a stock. It might sound confusing, but yes, a put credit spread is a bullish move. It's a bullish trade. So let's pick a stock that I'm bullish on. We'll select Ford, ticker symbol F. We'll go to Ford Motor Company, and we'll take a quick look at the chart. In the last month, the stock is down 6.43%. It has a support here at around $16.50. It has a resistance here at around $18.50. And let's say that we're bullish on the stock and we think that Ford is going to stay above $16.50. So now let's take a look at the options chain to try to find a way to trade a put credit spread on Ford. So what we're going to do is hit trade. We're going to hit trade options. We're going to select the expiration that expires in a month, so April 1st. Now, because this is a put credit spread, we're dealing with puts, and the first move is to buy a put. Now, what we're going to do is we're going to select a put that is just below that support line. The support line is $16.50. We're going to select a put at the $16 strike, which is currently trading at 70 cents, so $70. So we're going to buy that put. The next step is we need to sell a put at a higher strike price. Now, the further we go out and the higher the spread, the more potential loss we can experience. The closer the spread, the less amount of credit you're going to receive, but the less amount of money that you could potentially lose on this trade as well. Now, let's just say that we think there's a really good chance that Ford is going to get above $17 a share by the end of the month. So that's a $1 spread. 17 minus 16, that's $1. So what we're going to do is we're going to sell that put option. So we'll click on it, and then you will notice, sorry, I gotta go back, we'll click on it, and then you will notice it says put credit spread down below. So we'll click on that, and you'll see that the total credit for this position is $43. It's the difference between the premiums of those two put options, the one that we are selling and the one that we are buying. And all the calculations are going to be the same as that call credit spread option as well. If we take a look at our profit and loss graph, this is going to help explain things a little bit more. Now, our max loss is going to be $57. It's the $1 spread, so $1 times 100, $100 minus the credit we received. But more importantly, it occurs if Ford dips below $16 a share. So there could be somewhat of a down movement on this stock, and we still wouldn't lose all of, and we still wouldn't experience our max loss. That's why this is a bullish trade, because we think the stock is either going to stay flat, move higher, or just drop a little bit if we pick put options that allow that to happen. And in this case, we did. Now, our break even is at $16.57, which is basically where the stock is trading right now. Our break even is going to be that $17 put minus the credit we received. So $17 minus $43 cents, and that's how we get a break even of $16.57. Our max profit is going to occur at the higher strike at $17. So if Ford was to move up a little bit, we would keep all of the credit, all of the premium, and it would be a successful trade. That is why put credit spreads are bullish moves. So essentially, this trade would be profitable if Ford was to stay at the current price or above $16.50, and our max profit would be achieved at $17 a share. Our max loss would be achieved if Ford was to drop to $16 or below. The further it drops below $16, we don't lose any more money. Our max loss is capped at that position. Now that basically wraps it up for this video. I hope that I was able to explain how to trade credit spreads. If you like this video, then hit that subscribe button, ring that bell, and smash that like button. If you have any other questions, please consider joining the Patreon. It will give you access to a private Discord where I am there all the time, and 500 investors as well. We share all of our information. We share all of our trades with one another. We learn together, grow together, and make money together. But outside of that, it's been real, it's been fun, it's been real fun, and this is We Are Investing, and together we are invincible. See ya!